Kevin, how concerned are you and how concerned should investors be about political pressure on the Fed?
Well, it's appearances, and I think that's going to be with us for a while, unfortunately, until we get the next Fed chair put into place, where we go from there. But I think actually, is it Rick Rieder? Is it Kevin Warsh? I think we'll find out the gravity of the job. They understand the independence of the Fed, and I think we'll get past that. But are there going to be headlines over the next 3 years? Absolutely.
Are you sensing any panic in the Treasury market? Because we got cuts back in September, and the 10-year yield keeps moving up. It went from like 4.1% to now around 4.2%.
Right. I mean, that's, all rates don't respond the same way. And I think what we're finding out is the Fed did risk management rate cuts, not that they actually had to provide stimulus. And the economic data has been pretty good. You're talking about the Atlanta Fed GDP now, 5% in the fourth quarter. So I think the bond market is seeing that, and that's why we're getting some of that curve steepening.
Well, the data has been good, but inflation still has been sticky. What are your thoughts on inflation going forward? And maybe you can even comment on the dollar, which keeps declining.
Yeah, well, tariff-induced inflation doesn't look like it's going to rear its ugly head. Sticky inflation, percentage point or so above the Fed target of 2%, that looks like the more likely scenario as we go forward. And what's interesting, I'm not a believer in the selling of America and things like that, but you are seeing a pronounced buying in gold. And it's not just because of geopolitical events. You're actually seeing central bank buying and I think genuine interest from investors.
Okay, so what are your rate cut thoughts heading into 2026? Because we're still at the beginning.
Yeah, job market, if it continues to show that it is not falling off the cliff, up 50,000 new job creation, unemployment rate stays 4.5, maybe a little above, a little below, you're at or near the end of this rate cut cycle. And I think that is going to be a key story in 2026. Not whether they go when Powell leaves, but what happens? Is it 1 or 2, and then that's it?
And what does this mean for the yield curve? Is it going to steepen? Is it going to flatten? What are your thoughts?
That's a steepener. What would happen is the front end would be tied in with Fed funds. And why wouldn't the Fed cut anymore? Economy's doing good. Inflation is sticky. That's not necessarily favorable for longer dated yields.
And then finally, those are your thoughts on the yield curve. So which type of bonds should investors buy? Should they go for Treasuries? Should they go for munis? Should they go? Emerging markets have done extremely well. What are your thoughts?
Well, we like a passive active barbell. So we're focusing on Treasury floating rate notes as the passive part and something perhaps that's a little bit more active, total return oriented for the active part of the barbell. Combine the two, you don't have to put your chip on red or black as to what you think rates are going to do.
Corporates are going to be okay?
They're on the tight side right now. I think if you're in the leverage loan space, maybe there's some options you could look at from a quality screen perspective. But right now, corporate spreads are tight.
All right. Well, thanks for coming on and talking about it.
Thanks. Appreciate it.